Yeah.
Order filled. Check us out.
You know what time it is.
This is a Mighty Soldiers exclusive.
Yeah. Let's get it. Let's get it.
Good morning, guys. How you doing? I'm Andy with Mighty Soldiers Trades, and today we wanted to do something a little bit different. We wanted to bring some guests on from the community to show you guys what's available out there as far as educators and different trading projects or products. And without further ado, let's bring on Gianni.
What's up, Andy?
Good morning, Gianni. How are you?
Oh, it is cold here in Michigan. How are you?
Yeah, well, it's not cold here, but yeah, it's an amazing day. It's really beautiful.
Yeah.
So basically, Gianni, I just wanted to bring on some traders, and I wanted to help the community see what products are available. And you're one of the smartest traders that I've had the privilege to get to watch your videos over at Benzinga and stuff. And it's an honor to have you here. And I'd really like to just let everybody know what it is that you have to offer and what they could expect if they come over and join you. So.
Well, thanks for that, Andy. Yeah, so I've been in the digital trading pits, I like to call it, for about a decade. I was trained in the advisory world. So I was I worked in, investments and, wealth management and whatnot for about 6 years, 5-6 years. And during that time, I worked pretty closely with your institutions, your big dogs in the street, like Fidelity, your Schwabs, your Goldmans, your Vanguard, so on and so forth. And I was doing trades for a $250 million portfolio at the time. So when you are moving that kind of weight in the market, you kind of learn the rules pretty quick. So I learned what works, what doesn't. I learned how the PMs, the portfolio managers, and how the institutions, make their trades and investment selections. And I also learned a lot of, I have a bachelor's degree in economics as well. So I learned a lot of macro, not just in school, but I learned that some of the specific financial macroeconomic trends that a lot of these fund managers look at and use to, come to conclusions when it comes to investments, and then make decisions based off of said conclusions. So my time in that industry was very valuable, but I didn't really have the liberty to share research and publish what I wanted to. You kind of had to toe the broker's line, so to speak. So we left there about 2-3 years ago. It's been actually just over 2 years. And so we've been publishing through the Mercator letter, www.themercator.com. That's where we have our research. We have a monthly newsletter through the Mercator letter where we cover stocks, bonds, the dollar, crude oil, gold and silver index, as well as a few actionable trade ideas. And then we have a monthly cryptocurrency report. But then we also have another service coming in the pipeline in about a week or two, where we're going to be providing daily market updates across a variety of markets. So, if you're a futures trader and you like to trade grains or cattle or bonds or currencies, we're going to give you daily market updates on those, as well as daily updates for the stocks that we provide you in that monthly Mercator letter. So a lot of stuff coming. We're growing slowly but surely. But, the markets keep us busy most of the time. So we're just trying to watch what's going on there too.
Yeah, that sounds amazing. I've actually thought about working with traders that look at the markets differently than I do, and including a portion of their product in with my products. That way, people can get a much broader take. So that's really amazing, though. So you're as far as a trader, you don't call yourself a swing trader. You're more of a position trader. Is that correct?
Yeah, I'm a position trader when it comes to equities. Because when you're not dealing, it's not a leveraged market, right? And I don't really trade my equities on margin. I look for, bigger the base, higher the space. And, when you're looking to get, 30, 40, 60% returns on equities, there is some holding involved. But I do swing trading in my futures. I love to trade the grain market. I love to trade, bonds. And I've been trading metals and crude oil lately too. So on the futures, you really can't stay in for that long, especially if you're wrong. You can't afford to be wrong for long because it is a leveraged market. It's like, like every $1 move, for example, in corn is like, $50. So it's highly leveraged. So if corn's moving $1, well, it's technically a penny. So if you're moving one penny one direction, one penny the other, it's $50. So you can see how that can add up quickly to your advantage or to your disadvantage.
Right. Yeah. And you were saying the bigger the base, the bigger the space. I had caught your webinar last night. That was amazing, by the way. And what I really like about, honestly, I'd say you, Brian Shannon, and Anne Marie Band, you all say the same thing. You pretty much don't go long in a downtrend. Can you explain that to me?
Well, an uptrend is characterized by higher highs and higher lows. And so there's a saying in trading. I didn't come up with these phrases, by the way. It's just I heard them early on in my career, and they make a lot of sense. So the trend is your friend. And then I added something onto it at the end until the trend ends. But, we've been in a long-term uptrend in stocks, very long-term uptrend in bonds. But we've been in a short-term downtrend in stocks really since we made those new lows mid-month. We've been in a downtrend, and crypto's been in an uptrend. So depending on your time horizon, you want to trade with the trend as much as you can. But if you're a shorter term trader, there's really been excellent risk reward ratios on the downside in stocks. We sold all of our crypto at the end of November when we made new lows. We said the integrity of the uptrend is violated. So if we're trading with the trend, there's no reason for us to be long. And we didn't sell the high. I'm not going to tell you I buy the exact low and sell the exact high. But for me, there's plenty of meat in the middle to make a good living. And that's what I try to focus on.
Well, with BTC, basically, we had an uptrend. And what I was doing is I was trying to hit it on my alerts when it would pull back. And when I'd find some support, when we'd start to reverse back up to the highs, I try to get in there and ride it. I missed several of my alerts, though. That's one of my biggest flaws with that trading for me personally is just if you miss the alert, then you get there too late. You can't try to make up for that. You can't be like, okay, I'm going to get in now, or it's a totally different trade at this point. But yeah, just like you, I got out early, right before we started to turn around in Bitcoin. Took my profit, but I missed a chunk of it going up, a lot of it, because I was continuously missing my alerts.
Well, you make a really good point about chasing, and that's the mark of a disciplined professional trader. For that point, you can't chase your trades. If you miss the signal, you have to just let it go, because what it does by chasing is you skew your risk reward ratio. So I'm very rarely willing to bet 1 for 1. I'm not really, willing to risk $1 to make $1. I want to, risk 1 to make 3 or 4 at least. And if it can be even more, great. But, if I have I like to buy breakouts, right? So if I buy a stock, or if I set an alert and the stock breaks out and say I'm either, all in already, or I'm away from my desk and I can't, place the order. Well, I have to make a judgment call a lot of times and just say, okay, well, I have to wait for the next opportunity, because if it turns into a risk reward ratio where I'm risking 1 to make 2, I don't want to take those odds anymore.
Right. A lot of the setups that me and Sarah find together are more along the lines of 5 to 1, even 10 to 1. And what I like to tell everybody is I also like to plan for a nuclear option. Like, what if we have some sort of market crash? What if we have the most an event that you can't really foresee happening there, and that I want that to be my 1 to 1. If I'm going to make $100 in that nuclear option, I want to only lose $100. So that reduces my position size quite a bit. But at the same time, I then have the comfort of not having bad sleep at night, and I can just let it ride too. And easily I could take half profit and let it stop back out where I entered into that particular trade,
Yeah, position sizing, to your point, is so very important. I learned, it took me. I know some traders that get into the business and they pick it up within about 2 years. It took me about 5. I was a little more stubborn before I finally learned to size my positions properly and cut my losses. So I didn't pick up on it very quickly, but I didn't quit. I didn't give up. One of the rules I use is I never put more than 20% of my total given account in a particular trade. That's more for futures. On my equity trades, I go even smaller, because if you want to last in this business, you got to keep your money intact. If you approach trading like a business, your losses are like expenses. You're never going to avoid them, and you have to take paper cut losses to capture those big gains. So I view all my losses as a business expense, because I approach trading like a business. And there's really there's no way around it. No trader has 100% accuracy rate, but if you even are right 50% of the time, and your winners outweigh your losers by 3 or 4 times, you're going to make a pretty good living doing this.
And I noticed you said you're a breakout trader.
Yes.
So do you have any charts that you'd like to share? That you have any examples of what?
Yeah, I do.
For there?
I do. So the rule basically is buy high and sell higher.
Right.
And right now, as you can imagine, well, I have a chart of the S&P up right here, but we'll look at some trade ideas specifically. It's a little more challenging to be a breakout trader in a downtrend environment, but there are still sectors that are working, namely energy. Energy has been really the hot spot as of late, and we do have stocks. We own stocks like Marathon Oil, Devon Energy, and Baker Hughes. So we have the S&P right here, but let me pull up some of those energy stocks and show you the types of trades that we pulled the trigger on as recently as end of December, early January. So we have Marathon Oil here. We identified a broadening wedge pattern. These are known to be continuation patterns, which means they most often resolve in the direction of the underlying trend. So what does a continuation pattern mean? Well, you have to identify the trend first. So it's pretty obvious in Marathon Oil, it's in an uptrend. We have higher highs and higher lows. And the catalyst to get long on a stock like this is as soon as you close above resistance. So we basically bought Marathon right around here, and we got long, and we had a successful retest of former resistance turn support as well. And this is like a it's about high teens, low 20% return in a market environment where we're down 10-12% from the highs. So there are ways that we identify how whether money's flowing into the energy sector or not. But this is a trade that we're in right now, and it's working. We're making new highs, new multi-year highs, while stocks are down double digits off of their highs. So that's one trade that we're in now. One that I really like that I still think is pretty early is Baker Hughes, and I actually think that the weekly chart for Baker Hughes tells the bigger story here, because what I've identified on this one is a multi-year inverted head and shoulders pattern. And so, again, bigger the base, the higher the space. And so we have this reversal pattern, this inverted head and shoulders that's been forming over the course of the last 1, 2, 3 years or so. And we're just starting to close above the neckline as characterized by this upper horizontal trend line here. So that's resistance. This pattern's only confirmed once you actually close above resistance. So you see Baker Hughes making new highs, its highest level since October 2018. And again, this is despite a double-digit drawdown in equities. Now, one caveat I like to point out in these patterns, whether it's regular head and shoulders or inverted head and shoulders, is the shape of the shoulders, what I like to call it. So you'll notice here that the low of the right shoulder is higher than the low of the left shoulder. Whenever you see that, it increases the odds that a reversal will happen, because there are times that head and shoulders or inverted head and shoulder patterns can actually resolve as continuation patterns. These are reversals. So, you see we were in a downtrend, we made a higher low here. And there were a series of higher highs and higher lows before we broke out from this inverted head and shoulders pattern. But what this pattern did was confirm the end of the bear trend. Baker Hughes is no longer in a multi-year bear trend. It's in a multi-year new bull market now. And so, I just got into the stock a couple weeks ago, as soon as we broke above this upper horizontal trend line here. And, we're not up that much, but I think has a lot more upside. And this pattern is projecting prices as high as, $44, $45 a share. So that could be a lot higher from current levels.
That's really nice. And I heard you say yesterday something, basically, I can't remember what saying you had, but it was basically about patience,
Yeah.
being patient is the key. Do you normally look for a retest? Do you find, in my trade journal recently, I'm like, I got in too soon. I should have patiently waited that out. Or, I'm at a really nice entry, but I'm a little too heavy on that entry. So if it did turn against me the other direction, I have very little space to stop out too fast. So basically,
So I'll go back to the example on, actually, let's look at another example in these energy stocks, because they're really good examples right now. So what I'll do is I'll buy as soon as we close above resistance. So, this is Devon Energy. This is another one we have, double digit gains, while the market is down. So we got long in mid-December, right here. As soon as we closed above, let me get my trend line here. As soon as we closed above resistance, we got long there. So what I do is I set my stop losses within 7 to 8% of the buy point. So my initial stop loss that I set So if I entered there, I'll put my stop loss like right around, if my entry was around 43, my stop loss will be around, let's say like 30, like 39.40, right? But when we get that retest, what I do is I raise my stop loss up to here. So what this does is that I know this is not going to turn into a loser unless, we gap down 30% at the open. And then when that happens, there's really nothing you can do. And that's when position sizing becomes, of utmost importance. But what I do is once we get a retest, we have a higher low here. Well, that gives me an excellent place to further manage my risk, right? So if I raise my stop loss to here, it's not a big gain that I'm protecting, but I'm protecting myself from a loser. So, let's say I'll lock in a 5% gain at the very least, but I'm a big believer in cutting your losses short, letting your winners run. So, I'm going to keep holding this one for now, unless we start to close below, 45, 46 on this chart right here. So one of the most psychologically taxing things that can happen to a trader is to see a big winner turn into a loser. So one of my rules I use is as soon as I have a 12%, 13% gain, I'll raise my stop losses up to break even. But even better, I don't even think we were up that amount on this trade. Yeah, we were. So we were we were up around, 17, 18% at some point. So, what I would do at that point, let's see, I have to restructure this here. So if I was right there, I would, basically raise my stop. So that actually works out perfectly to right around 12%. So that's how I manage risk in live time. Is I'm looking for the formation of higher lows, because remember, if we're trading with the trend and we break to a new low, the trend is no longer, the integrity of the trend is invalidated, right? So the catalyst to be long ceases to exist. And, here too, markets, volatile today, we were up nicely. Then we had a sharp sell off. I haven't looked at it, since we started this discussion, but, it's still up. Devon Energy's up about 1% while, the market's struggling overall. So that's how, I manage that retest, so to speak. So I'll buy in the initial break. And then as soon as we have a retest, I'll tighten my stop loss is basically how I do it.
Awesome. And I see you have your RSI up here. Is that what we got?
Yes. I like to use the RSI indicator. I'm a fan of only using one indicator. Every once in a while, I'll look at, stochastics. And if I'm trading commodities, I'll use the CCI, the commodity channel, or what is that? I think commodity channel index. I forget what the abbreviations mean sometimes. But what's good here is that we were in a bullish momentum regime. We still are in a bullish momentum regime. And to go back to this rectangle pattern that we had here on Devon Energy, what I liked about this is how, as we spent weeks consolidating within this pattern, the RSI indicator never fell into oversold territory, right? So that's a really positive sign. Now, there is a slight case of bearish divergence in price in the RSI indicator now. So that means that we're making new highs in prices, but lower highs in the momentum indicator. That is a sign that upside momentum is waning, but that's never cause for me to abandon a long position per se. What I like to do is I like to tighten my stop losses up at that point. So like I said, our stop on this one is right around here. And if we start to close below there, I'm out. And, we can always buy these stocks back. They're not going anywhere. And one of the beauties about trading in 2022 is that most, if not all, equity brokers are $0 commissions. When I first started in the business, it was, 10, 15 bucks a trade. But you go back to, 50 years ago, it was hundreds of dollars to get in and out. So it really is a lot easier now, for better or for worse. Depends how good you are at managing risk and how disciplined you are in timing your entries and exits. But, the cost to get in and get out of trade is non-existent. So that's something we need to capitalize on as much as we can.
Right. So I noticed you were looking for the bearish divergence here. Do you use the Bollinger Bands also ever?
Yeah, I do sometimes. And I use Bollinger Bands more so for exits. So if I'm up nice on a trade, let's see if I can pop a Bollinger Band on here. So if I'm up nice on a trade, so you see the Bollinger Band. Basically what it does is it measures 2 standard deviations away from the mean. So we see that we're trading 2 standard deviations away from the mean right now. and we have this bearish divergence. So, this could be a cause to reduce our long positions to an extent, right? But we'll have to see how we close. I'm hesitant to make these types of calls earlier in the day, especially when I have an upside objective in this stock. Let's see, what is that? Well, no, we actually did fulfill our upside objective a little bit. So, it could be cause to reduce our long positions right now a little bit, maybe trim it a third, maybe trim it a half. But if we, get a bearish engulfing candlestick here, if we close below the lows of yesterday, after making a high above the upper band of the Bollinger Band, I think that's cause to take some chips off the table.
I can talk risk management all day, but you're looking at the macro situation. You're looking at markets overall. You're not just looking at one chart, one 5-minute chart, and saying, "Hey, let's do this." What approach do you take to even get into that sector?
Like in energy, for example?
Yeah, you're just watching the sectors overall. Are you using a percentage-based chart so you can see the differences between these, or?
Yeah, I'll use ratio analysis as well, but I look at 5 main asset classes now, and it used to be 4, but with the advent of cryptocurrencies, you can't ignore it anymore. It's too big. So I'll look at stocks, S&P, Dow, NASDAQ, Russell or whatever. I look at bonds. Bonds are very important. Bonds are not sexy, but they are the second biggest market in the world. They're much bigger than stocks. So what's going on in the bond market is actually much more important than what's going on in the stock market. I look at Forex because this is the biggest market in the world. So, here we're looking at a chart of the US dollar. Everyone's calling for the dollar to collapse. Meanwhile, it's making, multi-year highs. The dollar's breaking out from this rounding bottom formation, projecting prices up into this, $100 area. And, keep in mind, we're tightening, monetary policy. We're tapers over. Now the market's pricing in perhaps as many as 5 rate hikes this year after Powell's conference yesterday. So, this is catalyst for higher dollar. And you have to keep in mind that the rest of the world is printing money too. Would you rather own euros or dollars, or Japanese yen or dollars? So, that has to be a part of your thinking when you're looking at what's going on in the Forex market. Now, that being said, the dollar can rally as commodities rally too. And what does that mean? So let's take a quick look at crude oil, because you'll notice the dollar actually bottomed in January 2021, but then we made a secondary higher low in May of 2021. But if you look at what's been going on in crude oil, let's see, May of 2021, the dollar really started to accelerate. The dollar's rally didn't hurt crude oil, barely at all. So what does that say? That says, well, the world prefers dollars over other currencies, but we also prefer hard assets like crude oil. I guess that would be a liquid. That doesn't even matter. The world prefers hard assets like crude oil over dollars. So for a long time, when the dollar would fall, commodities would rise. But when the commodities rise, when the dollar is rallying, it really speaks to the strength in the dollar. So I don't look at any particular market in a vacuum. I call it the principle of interconnectivity. So what's happening in stocks or what's happening in bonds is going to impact what's happening in Forex markets, or vice versa, or commodity markets, for example. So as commodity prices rise, specifically crude oil has the largest impact on inflation expectations out of any other commodity. And it's not just for energy. It's not just for gas prices. Crude oil is used in a plethora of products, extending as far as, medicine, plastics, a lot of other, inputs and transportation costs for businesses. So if crude oil is rising, that puts upward pressure on inflation expectations. We now see that inflation data is at multi-decade highs. We're in a new macroeconomic environment. When inflation data rises, interest rates tend to follow, because interest rates are largely a function of 3 factors. You have the inflation factor, you have risk premium factor, and you have the demand for money factor. And all of those factors are firing in all 3 cylinders. So when interest rates go up, bond prices go down. So if you look at what's been going on in crude oil bottomed in April of 2020. And if we go back and look at what's been going on in the 10-year note, well, the 10-year note, well, if you look at interest rates actually bottomed in, well, it depends on the market. Interest rates bottomed right around March, April 2020. But sometimes you see, we call these divergences. So crude oil bottomed, let's say, according to this chart, in April 2020, but the 10-year note peaked in August 2020. So you can see how that rise in crude oil prices has been negatively impacting the bond market. We keep making lower lows and lower highs. This is a intermediate term downtrend, but the bigger story in bonds, as many of you know, is the long-term uptrend, right? It's been in an uptrend for the last 40 years or so, but I think that we are probably closer to the end of that bull market than the beginning. I think it's safe to say, but yeah, that's how I use, I call it intermarket analysis, using what's going on in one market to gauge what could likely happen in another. And that's a big theme in our Mercator letter that we publish on a monthly basis. And of course, now we have, what's going on in Bitcoin, not that exciting, right? Not very an exciting market right now. But people say, oh, it's a hedge against inflation. Well, if it's a hedge against inflation, then why is it down 50% in the highest inflationary environment that we've seen in the last decade, or almost 2 decades? So it's an asset class like anything else. I love the concept of blockchain. I'm not an anti-coiner by any means. Now, I think it is going to revolutionize the way we do commerce. But our exit that we had was right around here, and you see we made a lower low. I was willing to give it the benefit of the doubt for a while because it was a higher low than this one. But as soon as we formed a lower high and then broke to new lows, after this one, it was confirmed bear trend. So there was really no reason to be long. So yeah, those are the 5 main asset classes that I look at: stocks, bonds, commodities, currencies, and cryptocurrencies. And I use them, to make inferences about what could happen in other ones.
Right. Yeah. I love how you're looking at Bitcoin. I mean, every day now on Twitter, I'm seeing more and more, meshed up with the stocks and everything, and markets overall. Everybody's got their own theory, I guess you'd say, on how Bitcoin is affecting this or how this is affecting Bitcoin.
Yeah.
I kind of like watching it unfold. That's my point. But
the sentiment is so important too, Andy. You still see people calling for $250K or $1 million Bitcoin prices, and we're up, from the high to the low, we dropped 50%. So I don't think there's been enough capitulation yet from the bulls. And you have to recognize that when you've entered a bear trend, it takes the utter, complete, total demoralization and capitulation of the bulls in order for a bottom to unfold. That is just the law of behavioral economics. So I have a downside target in Bitcoin. I think it could happen, sometime this year between 12 and like 18,000. So, but in order for that to happen, we do need to see a close below 30,000. If we start to close back above, 46, 47,000, I'll alter that outlook. But for now, there's really no cause to be overweight or aggressively long this asset class, in my view. And as you can tell, I'm really not a fan of the hodling.
Well, one thing, I mean, when we see other stocks and even cryptos, when we see them surprising us in the chart, when we thought that they would have way more strength than what they're showing, like Netflix closing on below the 200 EMA on the weekly. Yeah, that to me was, I thought we could at least get a retest of that. Like, we're going to go that far, we can at least do something, to retest. And no, it's not exactly what's happened at all.
Yeah, I mean, this does not look good. The fact that we broke below the support here, in this $460, $480 range, to me, I think there's really no reason to be long Netflix until we recapture that resistance zone. And if you want to trade it, it's a bear market. This is a mean bear flag. And so when you see consolidation of losses, let's look at the daily chart here. Starting to see a consolidation of the losses. Consolidation of gains are bullish. Consolidation of losses are bearish. So It looks like we are flagging these losses. And, when you see that, it suggests, Netflix still has a lot more downside, I think. And this could sound crazy, but I wouldn't be surprised to see it fall as low as 230, 240. And if we go back to the weekly chart here, we have support right around here, in that 240 area. So I think before it's all said and done, we're going to see a retest of this zone. And, you mentioned, I should say we were talking about the RSI indicator. This is the first time Netflix has had an oversold reading on the RSI indicator on the weekly time scale in a very long time. I mean, we would really have to zoom out to see when the last time that was. So we've entered a bearish momentum regime on the weekly time scale. That's much more significant than an oversold reading on the RSI indicator on the daily time scale. So before we see a bottom, I would want to see some sort of divergence where we're making new lows in prices, but a higher low in the RSI indicator. And it might take, another, how much would that be? It might take another 30 to 40% drop before that happens. And that, again, that sounds crazy now, but as trend traders, that's kind of what I see in Netflix right now. And I think it extends beyond just Netflix. We're seeing this in a lot of tech stocks. Calling it a tech wreck. Recall that the NASDAQ, when it peaked in the .com bubble, it took about a decade for that index to recuperate those gains. So, that's why I'm not a fan of hodling. I'm not saying that the NASDAQ's going to peak and then take a decade to recover again. That's not what I'm saying at all. But components of the NASDAQ, individual components of the NASDAQ, could have that type of situation unfold again. And we can't even rule that out for crypto either. We don't know what the future holds. All we have is probabilities.
Yeah, Netflix, this morning we popped up quite a bit because, what is it? Ackman bought 3.1 million shares, I believe.
Who did?
Ackman.
Oh, really? Well, Ackman, I know you were around for this too. He has, in the past, he's a good trader, obviously, but I've seen him in the past buy stocks in downtrends, like whether it was Herbalife, and then there was a stock, was it VRX? It was a biotech stock way back in the day, like, gosh, this is probably 7-8 years ago, that he just kept, holding it and holding it and holding it, and it just kept trending lower and lower and lower. So he's made some really good calls, but, like anyone else, he's had some bad trades, and, I'm not immune to bad trades either.
Right. The one thing I keep saying this, but I've been saying it to them actually. Every video I've seen of yours, I just like how you're not getting into the trade early. You're not trying to jump into anything. Just because it's got this big discount, you're not like, okay, let's throw everything at it. And I like that sort of good example that you lead with that.
Well, I've learned the hard way, Andy.
That's the thing. I'm realizing that myself. The longer we're doing this, the more we just don't like to play anymore. I like to play a lot. I wanted to see every single thing that was going on behind the scenes, so I didn't really mind losing some money to get there. But just every single day there's that new wake up call that that's kind of not me no more. And
right.
I've grown up when it comes to this and that, and I want to see all these traders out here get there. And I think that the reason that we have you here right now, and I really appreciate you coming around, is that you're exactly what people need to be listening to. You're saying the right things to start this. And I like to tell people, not to try to like get rich, not to try to fill up your income. Don't say, okay, well, I need $4,000 a month right now.
Right.
How about we try to make $1 first,
Right.
And then if we can make $1 next month and $1 the month after that or whatever, let's try to find some consistency and just build that up to where maybe we can pay for a tank of gas and so on.
Well, you make a good point. The market is essentially a conglomerate of human actions, emotions, and so on and so forth. It's so much bigger, to get a little philosophical here. It's so much bigger than all of us. It is the combination of all of us put together. And, one of the things I mentioned when I was in the advisory world, I worked a lot with institutions. And when you're dealing with a stock like Netflix, let's see, the 20, well, it's up a little bit. So let's assume that it trades, 5 million shares a day, right? on average. You know, we had a spike recently, obviously, but 5 million trades a day times, let's say 400, you know, it trades billions of dollars a day. So the fact of the matter is, unless you're moving hundreds of millions or billions of dollars worth of stock, you know, trades on this stock, you're not even a blip on the radar. So and this is an advantage, something we need to take advantage of as individual traders and investors. I'm not moving, you know, billions of dollars, nor do I want to. Now, if my average trade is, you know, say it's even like 100 shares or whatever, you think 100 shares, you know, makes a difference on the direction of Netflix when it's trading, you know, 5 million shares a day? Absolutely not. But that enables us to get in and out of positions very easily. And you're seeing this unfold with, you know, Cathie Wood. You know, she was she was on fire. She was the momentum, you know, trader at the time, but she can't get it. She can't sell, you know, hundreds of millions of dollars worth of, you know, Tesla or whatever at a whim, but we can as individual traders. You know, she's managing billions of dollars. So we have to use that as an advantage. And, you know, I've used this military analogy before. Someone like Cathie Wood or Bill Ackman, you know, they're like heavy artillery. But, you know, you and I, Andy, we're like snipers. We can get in and out of a position like no problem. No one's even seen where it came in. So, you know, the point of that explanation is that as individual traders, we need to trade with the trend, because we're not going to change the direction of a stock or a market's trend simply by the virtue of not having enough money to do so. And a lot of times, you know, there's legendary stories about this. You know, go back and look at what the Hunt brothers did in the silver market. They tried to corner the silver market in the 70s. They tried to basically buy all the silver in the world, and they ended up blowing up for it because they were trading against the trend. You know, Warren Buffett did stuff like that in the silver market too. So there's all sorts of stories in history. You go back and look at economic history, whether it's John Law and the Mississippi bubble and stuff. When they try to corner the market, they usually end up losing. And, you know, so respect the trend. The trend is your friend is the moral of the story.
Speaking of a military saying, I'm up, they see me, I'm down. That's basically what I trade a lot. I call it playing in the freeway, and what it is trading penny stocks or small caps, you know. And the more I'm doing this, sometimes I'm just like, you know, I'm not touching that. And I think one day I'm going to get to the point where I'm not going to touch any of them, no matter how good I am at it. Because, you know, if you have that one off day, and that's the thing about a win rate that really doesn't matter. You can have the best win rate in the world, but if you have one off day and you get yourself over leveraged slightly, you know, now you're giving back gains from like your weeks getting smaller, or shoot, you may have your week turning red. That's never good. But yeah, just growing as a trader, and I don't know. I think one day I might no longer trade penny. I don't know. I keep a portion. I'll keep a little portion for play.
I traded penny stocks in the past. I don't anymore. And that's not to discourage anyone from doing so. I mean, there are profitable penny stock traders. It just doesn't fit my style. You have to find an approach that fits your style. And, you know, you also have to be comfortable with, and, you know, there are times I go periods of 2 to 3 months where I don't really make much money. And sometimes I'm down. But when I'm right, I'm really right. And I'll hit, you know, not just a home run, a grand slam. And, you know, there was like in 2020, for example, in the futures market, I made all of my money in the futures market in a span of like 2 months, 2 to 3 months. The rest of the year, I was pretty much flat, you know, and it ended up being a really good year. But you have to be comfortable and just stick to your method, cutting your losses short, avoid revenge trading. You know, you might have 2 to 3, 4 losses in a row, but don't try and recuperate those losses. The market is trying to tell you something, and cash is a position. If stocks are down and you're in cash, you're actually up. And that might not make total intuitive sense, but, you know, I want you to think of it like, you know, in the theory of like relativity, right? If stocks are down, well, and you have cash, well, your cash can actually buy more of those stocks, right? So you're actually up in a way. And revenge trading has never worked out well for me. And once I stopped doing that, my results improved tremendously. And, you know, when you are right, you know, you have to have the confidence to double down, and sticking to a method really helps that, you know, because I'm not a fan of eliminating all of your emotions, because if you eliminate your emotions, you eliminate your intuition, and having some intuition in the market is important. You know, don't ignore your gut. If something is saying, you know, if your gut's saying something is wrong, listen to your gut. And you can, I found that when I stick to my method, my intuition actually works better. When I try to say, oh, you know, I'm just going to go with my gut, it sounds counterintuitive. But if I say I'm just going to go with my gut all the time, well, you know, there's a fine line between going with your gut and starting, you know, to double down with ego trading, right? I'm not a fan of getting rid of your ego. You have to control your ego, drill it into submission, basically.
Yeah, what I always say is, you know, we don't cry over missed gains, and we definitely don't try to recoup losses.
No.
We just trade better every time. It's like Mike Bellafiore says, you know, one good trade, and then one good trade, and one good trade. And if we're worried about how much we've made, how much we lost, or where we are on that scale of how much we're making in our account, that takes away from that one good trade, you know?
Yeah. So, yeah, and that's important too. You know, the philosophy of trading. There's a phrase, Michael Guyad, he says it a lot. You know, the ability to stick to a strategy matters more than the strategy itself, and it's so true.
Yeah, just I don't know, man. So many great people in this community to learn from, and you are definitely up there. When can we look forward to a book, Gianni?
Well, that's funny because one of my friends and colleagues, Ray Merriman, I do a lot of work with him. He's been encouraging me to write one in the next year or two. So I'm teaching a course with him, which wraps up at the end of this year, and maybe in between this course and the next one will be a time. And you know, it's basically going to be chart patterns. I do a lot of cycles work too. We didn't get into that today. You know, because, you know, at the end of the day, there are two axes on this price chart. There's price, you know, the y-axis, and then there's time, the x-axis. So, yeah, I mean, there's a lot of lessons that I've had, a lot of hard lessons that I've learned over the last 10 years. And, you know, I don't know that I have ever, you know, there's a saying, you know, there's nothing new under the sun. I think it's actually a biblical verse. There's nothing new under the sun. And I just view myself as a good synthesizer, you know. I'm able to pick, you know, what works for other people and synthesize them into what works for me. Because, you know, these chart patterns, you go back and, you know, they've always existed. It's because human behavior has never changed. You know, yeah, there's different cultures. Yeah, there's different, you know, people and tribes and so on and so forth. But at the end of the day, we are all human. And as a result, our behavior and our behavioral tendencies are pretty much the same. So that's why chart patterns exist. That's why we can measure and observe those patterns. So yeah, I you know, in summary, yeah, I will do a book, hopefully in the next year or two.
Yeah, out of all the people that I'd like to see a book, I would love to see one from you, and I'd love to see a really nice book on the strat from Rob Smith. That'd be a great book as well. And I know that it's definitely going to be coming. I can't wait to see it.
Yeah.
But as far as your sweet spot on your entries for the breakouts, so are you more you're not concerned that it's going to come for a retest? Then you're just using that to bring your stop up.
Yep, that's
correct. A way for you to lock in. Yep.
So that's exactly it. I mean, you know, and if I missed that initial entry, yeah, you could, you know, buy there too. But my primary focus is buying that initial entry, you know, because then you could always, you don't want to give yourself, you know, you don't want to give yourself too many options to enter a trade. Just keep it simple. Hey, I buy on a break to new highs. I buy specifically when we close at a new high. So Andy, 90% of my equity trades I make in the last 15 minutes of the day, because we want to avoid false breakouts as much as we can. There's a saying in trading that, once again, I didn't come up with: from false moves come fast moves. And, you know, we see that happening. I'm trying to think. I talked about this with Rodrigo yesterday. Oh, it was some of these semiconductor stocks. And this one specifically, you know, this Applied Materials, this had a really nice setup here. You know, arguably, you know, we were breaking out of this rectangle. You could even make a case it was a saucer. But you can see here, false breakout. This was a clean breakout. I would have bought this breakout right here. You know, we broke out from this, but I always maintain my stop loss. So I would have bought it and been stopped out the next day. But would you rather have sold right here or right here? Right?
Right. Yeah.
I don't care about being wrong. You know, I really don't. It's something you need to train yourself, because humans, we have a tendency to be optimistic and have abundant mentalities. But as a trader, you need to be obsessed with risk. What am I willing and able to lose? And then stick to that.
Now,
So,
if you're buying this as a breakout and
Yeah.
you stop out here and then you see we drop off, I call this a cliffhanger pretty much.
Yeah.
And you go up for that the previous support is now resistance. Are you looking to play the downside? Do you play the downside on these?
I don't short stocks. If I short stuff, it's usually in futures.
Okay.
Yeah. So in futures, I would consider doing that, but I mainly trade with the trend. This stock is still the short-term uptrend has been violated in this stock. This low is clearly lower than the lows here, right? But this low is still higher than this low. So it's just a sloppy trend. This is not something I'm going to touch for a long time. So, we were talking about the bond market before. That the bond market is something that's been in a downtrend. I've been shorting treasuries basically since fall of 2020. So as soon as we broke below this rounding top in the bond market, this is pretty much one of the few things I've been shorting. I've been shorting the euro as well, because I think the euro the euro has a lot of problems. Ever since we formed this lower high here in January of 2021, I've been short the euro. I've been shorting it across various time frames too. And then we had this inverted saucer here too, and I have an initial downside target in the euro right around 109, 109.5. And we'll see what happens. I think the euro could even go back to par at some point. Keep in mind, the Fed's about to hike rates 5 times this year. The euro hasn't even moved on short-term interest rates. I'd have to double check. I don't know if they're still in QE in the Eurozone or not. But I mean, it's like a no-brainer trade, in my view, from a macroeconomic understanding and from a trend following understanding. So yeah, again, I try to stay pretty disciplined with the trading with the trend. And so I'm not going to short a stock that's been in a bull trend. I'd rather just be in cash at that point. And then if I'm going to short stuff, I'm going to focus on shorting the stuff that's in a bear trend.
Yeah, so I don't really have, in my day-to-day life, I don't really have much time sometimes. And the time that I do have, I got to get out and stay alive, stay moving, find time away from the screen. But as far as products go, man, what do you have? Because this is the time that I would love to have the products that you have,
Well, I have the Mercator letter, monthly report. We just published the most recent one last Sunday. So we publish it once a month. We do stocks. We give an overview of the S&P, the 10-year note, the U.S. dollar index, crude oil, and then we do the Philadelphia gold silver index. And then we give you 4 actionable trade ideas. And then we update you on what our previous picks have done. We give you a couple other, I call them like the 7 key rules that I like to use when I trade. And then I give you a macroeconomic overview too. We'll look at stuff like what's going on in the yield curve, for example. We'll look at credit spreads. So, we'll talk about all this type of stuff and provide it to you in a pretty concise format. And then we have the crypto report, which, got readers out of crypto basically at the end of November. And then, as I mentioned before, we're gonna be coming out with daily updates as soon as the second week of February. So right around February 7th, February 8th is when I plan to debut that product. We're gonna call it the Mercator Tactical Market Trader, and it's basically gonna be a daily update where it's going to be a spreadsheet where we just say, hey, we're bullish above this point, we're bearish below this point, or we're neutral. We'll give you daily updates on our stock ideas and other actionable trade ideas. So stay tuned for that. It's something that I've been working on with some friends because we've had some pretty pretty strong requests. It's like, hey, you need some daily updates. But I started, as just a monthly newsletter publisher, and yeah, it's crazy how things can grow, and just stick to it. And I really enjoy writing these reports because I noticed that it gives me a plan to follow. So I write the reports, and then I just have to remind myself, all right, G, follow the plan. You wrote it all out. You spent hours analyzing the markets. Just follow your plan. And what's so helpful is that when I go back and I look at what I wrote, there was a time, I wrote these newsletters like kind of under the radar when I worked in the advisory world. And I just published it amongst, close family and friends. And it was like a big aha moment, because when I wasn't trading well, it enabled me to go back and look at these reports. And I was like, wow, if I had just followed what I wrote this, I would have made money. And it's self-affirming. It helps build your confidence, and just say, stick to the plan. Everything else is noise. Stick to the plan, stick to your strategy. You did this, you wrote this out, follow it. And it helped me improve tremendously as a trader. So repetition is the goal, the holy grail, basically. And the strategy is what you have to keep repeating.
That's the thing, when we're here trying to provide value to the community, whatever nuggets we're able to give, those are things that help us as traders as well. They help to keep us in line, help us to grow, accountability, So it's really nice to have the chance to be able to be a part of the community and help the community, because it helps us in return. And I mean, yeah, I gotta say, man, I'm excited about your products. I like the whole idea. But one thing I was gonna say is you don't really have to put out. I mean, I know you're trying to put out more stuff, but sometimes it takes just a couple sentences. This is a whole bunch of research went in there for this little bit, and this is where the meat on the bone is. This is where it's at.
Yeah, there's you make a good point. There's really no need to overcomplicate things. So I really do try to keep the report concise. I have a chart, and then I fit the entire summary of that chart on one page. So I'm not trying to impress you with financial jargon. Yeah, is there financial vocabulary in there? Of course. You need to be. I mean, I don't really know how else to, if you want to talk about liquidity, you got to talk about credit spreads, right? And if you sign up, send me an email. Hey, what are credit spreads? I do define them occasionally in the report, but there's a few different ways to look at credit spreads too. It's basically the difference in yield between different types of bonds in the market. So, one of my favorite ways to look at credit spreads, for example, would be between, investment grade corporate debt and treasuries. Those are arguably two of the higher quality types of bonds out there. And if we're seeing the spreads widen, well, it's a sign from the bond market that, there could be some issues with liquidity. And I learned that when I was in the business. So, Andy, I did want to say I did set up a special coupon code for members of your community as well. And, thank you for having me on. It's been really great to be here with you. Just use ticker symbol. I'm so used to saying that.
Yeah.
Coupon code Mighty Soldier, and it'll get you 20% off all annual subscriptions. And that's going to be in effect until next Friday. But I did mention, I'm going to come out with that new product on the 8th. So I'll actually extend that until February 11th, in case you want to apply that to that new service as well. So yeah, it's been really great talking with you, Andy.
Yeah, I was going to tell everybody we do have the link in the description, so anybody who wants to try this out, the replay will also have the links in there. I have the coupon code, and you said that expires. Yeah,
I'm gonna right now it's the 4th, but as soon as we get off with this, I'm gonna extend it to the 11th, February 11th.
All right, so February 11th, I'll put a reminder to take that off any replays. But yeah, it's been great having you, Gianni. Do you want to briefly let us know anything you're watching real quick before we go?
Well, I talked about this in the boot camp this past weekend. I was looking at precious metals, but I'm starting to, let's see. Yeah, it's not looking good on that front. I might have to modify my thesis on that. Yeah, I mean, Powell keeps talking up the dollar. The interest rate hikes are definitely going to be a tailwind for the dollar. I did have precious metals on my radar, but this isn't the price action I want to see. So I might have to adjust my thesis. Fortunately, I don't have any big losers right now, but I probably am going to get stopped off of a few mining names today. But, honestly, my biggest winner right now is SQQQ. We're down a little bit today, but, we did get in on this at a pretty reasonable time. And then the energy stocks, I think energy is going to keep trending. Let's actually look at one quick last chart here, and it's the ratio between energy and the S&P. And I think this is the most important chart, arguably, in the entire market right now. And I think we broke out from this inverted head and shoulders. And, energy was never cheaper than it was relative to the S&P. In November 2020. And I think we confirmed a new bull trend here. And I think it's going to increase in terms of importance for the S&P 500 in contrast to what's going on with tech, which I think, tech has led the market higher for the last decade almost. And I think we're finally could be seeing the unwind of the growth outperforming value. So I think that's a big key. So if I had to summarize, what to look out for the remainder of 2020, it's value and inflation sensitive segments of the market outperforming growth and tech. I think we have the macroeconomic environment suitable for that now. And so we're going to see a lot of energy names and basic materials and financials, banks. I do think precious metals will eventually have their day in the sun this year. I just think may have been a little premature on that call, but that's okay. Like I said, I don't really care about being right. I care about making money. And part of being able to make money in the long run is knowing when to admit you're wrong. And so I think I'm a little early on that, but I think I can look at this real quick. I think GLD against SPY, you can see we turned down a little bit this week, but I still think that we're breaking out from a falling wedge here on this ratio chart. So we'll see what happens there, but, might need a little bit more back test in the formation of a higher low before that's confirmed. So that's on my radar for this year. That's what I'm looking at. I think energy is going to be your best friend in these next couple months.
Well, Gianni, I love how you take something that could otherwise seem very complicated. You say it in terms that these traders, all levels, I think, can understand. And if they don't understand something like a simple maybe capitulation or anything else that we're talking about here, can simply ask, and I'm sure you'd be happy to answer. And even on Twitter, your Twitter is right there on below your name. I think we got a link in here in the video. So anybody wants to go and check out Gianni, what he has to offer, got these links here. Go follow him on Twitter. We really appreciate you coming around and giving us your time today, Gianni. Thank you so much.
It was a pleasure, Andy. It's always great to speak with you. And, if you're ever back in Michigan or I'm down in Florida, let's definitely get together.
Absolutely. And I look forward to getting together again in the future, maybe another boot camp. And if you ever want to come back around here,
absolutely,
happy to have you. So
yeah, I'd be glad to.
See you next